Market timing is stupid. Yep, I said it. It's stupid, especially for dividend investors. And I know a lot of you are getting triggered right now. How dare you? Let me just take a cup. That cocoa bean, baby. Hope you're loading up on some coffee. You just don't know. Anyway, the reason is, well, let me just go right into it here. The reason it's stupid is this right here. We had a million different charts. It's time in the market, not timing, market timing that matters. And this is from Schwab, only 1996 to 2015. You can do any 10, 20 year, 15 year time frame. You have the exact same numbers. Well, not the literally exact same, but pretty close. And basically from 1996 to 2011, a 15 year, about 15 year time frame, which included two of the worst bear markets in histoire. That means history for you non-multilingual speakers. You know I'm joking when I say I'm multilingual, right? I say cocktail, Maricombe, histoire, donkey shorts, and gracias. That's the extent of my bilingualness. All right. Maricombe. Oh, man. All right, anyway, so here from 1996 to 2011, if you just sat in the S&P 500 and looked out the window, like, well, Finney's not doing it anymore, but he was just a second ago looking out for Fauci. Is Fauci doing okay, by the way? We got to get an update on old Fauci. You would have averaged 7.8% a year from those 15-year time frame. If you missed the best 30 days, you would have actually lost money in the S&P 500 by just missing the best 30 days. All right. Now, and rightly, everybody and their mom will say, yes, but what if you missed the worst 30 days? You would have done better. I get 100% get that. So the argument against this chart is, yes, but this is biased because you could have easily also missed the worst 30 days. Well, but the point being is, if you're going to be in the market, you just sit there and look out the window, then you would have captured 7.8%. Because let's just be honest, it's impossible to miss the worst 30 days and to get the best 30 days. You can't do that. It's impossibility. I mean, you'd have to be, essentially have to be God. You know what I'm saying? Or you have to be Biff and go back in time from Back to the Future 2. And you can't do that. I mean, at least that I'm aware of. So you can't miss the worst 30 days and capture the best 30 days. And you can't do that. And you can't miss the worst 30 days and so I'll just capture the average. You can't, because you just don't know. So if you're going to be investing, just sit there, man. Now, I mean, that's all there is to it. Now, when it comes to dividend investors, it's even worse if you try to market time. And here's my man, the dividend guy, and I've been following this guy for a long time. I haven't received much from him lately. I'm not sure if I'm not on if he's fallen off my radar or not. But I love this article. While trying to play the crystal ball reader will not work. He says will not likely work out. It won't work out. It's just dumb. And so let me just define what market timing is. Because right now I'm very keen on long-term bonds, actually. So I said long-term bonds look quite attractive to me. And as such, and when I do videos saying, yeah, they look pretty good, people are like, oh, you're market timing. No, I would say that's tactical or strategic allocation. Strategic allocation, taking advantage of what I think are buying opportunities. I'm still heavily invested in Wellington VTI. That's when I'm just talking along the perimeter. I'm putting a little bit more money in things that look attractive to me for the long term because they've been beaten down so much. I could absolutely be wrong. But anyway, that's not market timing. Market timing is basically going all in and going all out. Say, I'm getting out of the market because of Biden, or I'm getting out of the market because of Putin, or I'm getting out of the market because this, that, and the other. I'll get back in when things level off. And I always say, well, what does leveling off mean? And usually they say when it gets back to normal. I said, what does normal mean? When it goes back up. I said, well, if you already know the market is going back up, why don't you just stay in there to ride it out? And they rightly so. They'll say, well, because I might be wrong. And I get that. But that's definitely market timing. You're getting out, getting in, getting out, getting in. My man Eric from Wisconsin, he got out, I think he said in 2009 or something like that. And he didn't get back in. I'm not sure when he got back in, if he has even got back in. I've heard this 1,000. I had a guy I fired as a client because he's like, look, this is about 3 years ago, maybe 2 years ago. And I remember he he sent me a check and I refunded his money because he said, I just need to know when to get back in. I said, what? I said, I can't tell you that. Dude, I said, there's no upside for me in taking you on as a client whatsoever. And the reason was because if you got out in 2008 and 9 because you were scared of the market, you missed the I mean, I think it's the biggest bull run we've ever had, maybe the second biggest, but along the top 5 biggest bull runs we've ever had. Now you got FOMO, fear of missing out. You're like, I got to get back in. And if I told you to get back in now, well, what just happened? What just happened? Well, we're down 25%. You think that guy would be happy with me? No. No, he'd be like, you told me to get back in. That's why I said, I'm not taking you as a client. No way, no how. Because there's no way for me to say you should get back in because you should have been in the whole point. There's no upside for me. If the market goes up, he's like, all right, great. That doesn't do me any good. If the market goes down, though, I'm in a world of hurt, that's for sure. All right, so let's see what my man talks about, why dividend investing, it doesn't make sense to be a market timer. One of the major advantages of dividend investing is that you get paid while you wait. In 2008, your portfolio would probably show a negative return of about 30%, but the dividend payments you received through the year were more or less the same as what you got in 2007. I do take a little bit of issue with that. If you look at the bank stocks, the dividend payments dropped off like a brick in water. They were still paying 1 cent to make sure that they could still pay their preferred shareholders, but I do take a little bit of issue with that. But still, be it as it may, I get his point. He's saying, look, if your stock price was down 30%, but the dividends, all in all, were still paying roughly the same they paid in 2007. In fact, the dividend payouts of many of the companies would increase even during bear market times. Therefore, sitting on the sideline and waiting for the next market dip is synonymous of losing 2 to 3 to even 4% dividend return by waiting. I cannot believe, I 100% agree with that. 100%. Are you rich enough to leave that money on the table? I'm not. Let's see. I will start by telling you that the true power of dividend investing resides in the compounding growth rate of the payouts received. If you wait on the sidelines for 2 to 3 years and wait for perfect market timing, the company you've been looking at will increase its dividend payouts by usually 5 to 10% a year without even sending you a single check. Come on, Brits. We CHECK, man. Next thing you know, you're going to say, you're going to be spelling, what do they say? Another way they spell stuff, I forgot. But come on, I'm going to spell a check. You Brits, you guys don't know English. As an example, let's take the mother of all dividend stocks, Johnson & Johnson & Johnson. Over the past 53 years, and he wrote this in 2017, J&J has increased its dividend payout each year. Never missed a payment, never missed a dividend raised. However, during the same time, the stock price has gone up and down. You can see here's the stock price. Zoop, kaboom, zoop, kaboom, zoop, kaboom, zoop, kaboom, kaboom, zoop, zoop. This is 2007. I have no idea what Johnson & Johnson is doing right now. I literally could care less. But here's a dividend, right? A little bit of a drop right there. I wonder what happened there. But even during the great bear market, kept going up, kept going up. Look at that. Dividend payout. Now, the interesting thing is, check this out. The dividend payout is increasing, is going. You're still getting the dividend payouts. You're buying shares right here, not right here. You're buying shares right here, not right here. Now, you're still buying shares up here too, but it's the best dollar cost averaging strategy you can have. Excuse me, Corona. When you look at the orange, you'll notice that shareholders went through good and bad periods. Some had to be patient. But on the other hand, the dividend payment has continuously increased year over year, beating the rate of inflation significantly. I completely agree. All right. All right, so that's what he taught. I cannot agree more. I mean, look at that, man. Just the payment, the dividend payouts, just every. Let's take a look at Johnson & Johnson right now. And Johnson, hold on a sec. And in no way am I saying this is a stock you should buy, but from 2017 to today, 5 years since that guy wrote this article, hope he's still around. We'll see the dividends. Let's just go to, I guess he got, what's that? All right, dividend. Paid 84 cents in 2017, 95 cents in 2019, 106 in 2021, 113. And I mean, look at that. Dude, I freaking love dividends, man. But Warren Buffett doesn't love dividends. I don't care. I don't care because I'm not Warren Buffett. I can't buy and control companies, and neither can you. So in 2017, it paid 84 cents, 5 years in, zero payment. Now it's paying 113. Oops. Go ahead. 5 years. That's a 6.1% compounded annual growth rate. And the stock back then in 2017 was, does it give us a price? Right. It's hard to see, but it looks like what one. No, I just look. Again, that is weird. Why is it? Let me maybe not show it. There we go. It doesn't tell us a price though. So what is that? This 109 is a low. I'm assuming that's 130. So the stock has gone up by 34% in that time frame, and the dividends have averaged 6.1% a year. Let's go to Portfolio Visualizer. This Portfolio Visualizer, $10,000 in J&J has a compounded annual growth rate of 11%. All right, so does it show us their income? I think we can get it to show the income here. Hold on just a second. I guess the total return. All right. Let's see. We can go to show it. Am I recording? Okay, cool. Show the income. Let me pause. All right, so here's the income. Let's take a look. So 10,000 invested in Johnson & Johnson paid you $291 in 2017, which is 2.9% yield. All right, so then 318 on your $10,000 invested. All right, so that's a 3.18% what's called yield to cost. How much income are you receiving on your initial investment? 3.4, 3.7, 4.09, and so far this year is 218. It just so let's not reinvest dividends. I tell you, man, I love dividends, and you should too. So let's not reinvest. So if we don't reinvest dividends, we only got 8.18%. Isn't that interesting? So Johnson & Johnson reinvesting dividends gave us what did I say? 8.18. So dividends equated to 11.06. So dividends equated to 27% of the return of Johnson & Johnson in the last 5 years. Let's just go back to 2000. I just want to see here. Blink. So if we don't reinvest, I don't think I'm reinvesting dividends here. Let's see. Yeah, I am. Okay. So if we reinvest dividends, we get 8.86% on compounded annual growth rate. And here's our ink. Look at that. Just, oh, dude, that's just a thing of freaking beauty. That's just a thing of beauty. So what did I say? 8.86. Is that what our 8.86? All right. So let's not reinvest dividends and see what we get. 6.12. So 6.12 divided by 8.86. So dividends represented 30% of the Johnson & Johnson's returns. Anyway, there you go, man. Don't market time. Buy dividend stocks and hold for the long term. All right, we'll see you.